Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. So today we're going to finish off looking at the Dow Jones Industrial Average components. We've already done about 2 videos. This is the final one. And the reason I selected or wanted to do this is because a lot of the companies in this portfolio or in this ETF is companies that I own, number one. And number two, they have a free cash flow, that's great. They have a competitive advantage or a moat. They pay dividends. They buy back their shares. They are great companies in a really good business model and great business models, basically. Okay, and this is the type of business that you want to own around this time. Although companies like 3M and basically been crashed the last couple of days, again they are holding on better than some of the companies out there in terms of the high flyers, if you think about it. So that's what we're going to look at today. But before we do this, let's just look at again the sectors, the S&P 500 sectors, and just for this week. And as you can see, there's a lot of red apart from consumer defensive. And this is what I've been saying all along. The companies in the consumer defensive are the ones that grow their business model about 3 to 5%. If you get more than 5%, you're very lucky. They pay solid dividends. Okay, a lot of these companies in here are dividend kings, like Procter & Gamble's, Coca-Cola's, and Pepsi's, and so on. Okay, they pay dividends, like I say. They buy back their shares. They have a plenty of cash. Okay, so these are the companies that are surviving right now, and everything else. And when you look at the opposite of the consumer defensive, this is the high growth sectors like the technologies, the semiconductors, the communication services, and so on. The cyclicals as well are not doing well lately. So yeah, you can see, for example, companies like CRM or Salesforce is down 8%, is now almost below 200%, $200 per share. That is absolutely ridiculous. This stock was almost 300 not long ago, or over 300 not long ago. Adobe, look at that, now below 400 and about 460ish now. Not long ago it was basically about $600 per share. I think that's when I started buying, unfortunately for me anyway. So yeah, there are a lot of red. It's just this week. And then when you look at just yesterday, okay, yesterday was a crazy day. And as you can see, there was a lot of red. What surprised me the most was Nvidia. Nvidia basically reported really good quarter. The only negative I went through their earnings report. The only negative I could see is the RM deal that didn't go through. That was it. The rest of it was fine. They grow in data centers. The gaming side was absolutely amazing. Every sector basically have 3 main segment of business, business segments, and all 3 of them are growing, and they generating a lot of cash. But at the same time, their stock is down almost 8% just yesterday. So yeah, things are just a little bit crazy at the moment. But again, as usual, like I've always said to you, I'm not basically changing anything. I'm adding to the companies that I own already that are down. If you go to my Instagram account, you will be able to see some of the sale buys that I made yesterday. Not yesterday, day before. I made some more yesterday, which I will be sharing with you guys very soon, inshallah. If you like this kind of transparency and this kind of analysis, just like the videos, please, and subscribe to the channel. All right, let's get started. So the first thing we're going to look at is, the first company we're going to look at is Amgen. Amgen is one of the companies that I own in my portfolio. They're currently trading $221 per share, quite a bit down the last few days. They were up quite a bit. I think were like 140s, 160s at some point, and then they came back down again. Currently PE is 21. The sector, we're looking about 24, so it's cheaper than the sector right now. The reason we use PE is just to compare with the sector or another company like for like. EPS $10, market cap of $129 billion, annual dividend of almost 3.5%, 5-year growth rate of 12%, which is absolutely brilliant. They grow their dividends amazingly. Dividend growth streak of 10 years, and then a payout ratio of only 41%. So they've got massive improvement. So they only basically spending 41% of their net income to pay us dividends. Okay, they can increase this because this is actually, there's a massive room for improvement. This is why it's best to buy stocks whose dividend payout ratio is actually lower than 60%, because then that gives them the chance to improve or give you more, instead of buying companies who has I don't know, 70, 80, 90, and then there's no room for improvement. And if the stock goes down, something happens, they cut it. Dividend safety of 74%. And then free cash flow of overall almost $8 billion. Beta is very, very low. Current ratio, so this is basically the debt level. So what we're looking at is the next 12 months, they've got, if it's above 1, then that means they've got enough money to pay off that debt in the next 12 months. And then you've got profit margins of 73%, return on equity 22%, future growth about 10%. This is down almost to 51% according to undervalued, 51% according to Wall Street, simply Wall Street. Target price of $456 per share. It's, for me, is a moderate buy at the moment. And then this is just for me now. I think they've said it's a buy, but I think it's a moderate buy because I want the price to go down slightly lower. If it hits about 200, I think it'll be perfect timing for me to buy another maybe 10-15 shares of this and just forget about it. And then Morningstar saying it's 14% discounted, 260 is what they're expecting. And tip ranks almost kind of similar, okay, $243 per share. So it's got massive upside, about 10% there, 14% there, 50-something% there. So it kind of more or less all of them agreed it is a buy at the moment, and it is basically undervalued. When you look at Zoya on this company, by the way, you will see there they are not Sharia compliant. And the reason for that is because their debt to basic level is about 31 or almost at 31%. So remember, those Zoya uses about 30. All the other people, everyone else basically says about up to 33. So again, give or take, I'm not selling it now. If it goes above 31, then I will get out of it. 33. If it goes above 33, then I'm going to get out of it. But right now, if you basically calculate the debt levels, you will get about 31. So for me, I'm still comfortable holding it up to 33%, okay? Because that's what they use for the ETFs and all that stuff. So why not use that instead of 31? And it changes anyway. Remember, the stock price changes every day. The market cap changes every day because for that reason. But if you're looking at for quarterly perspective, then obviously that is fine. And I think that's what they do in Zoya anyway. They don't update it every day. They just update it once every quarter. Right, so the next company is Cisco. Cisco reported their earnings yesterday and they absolutely smashed it. And that's why they were up yesterday at one point about 4%. Okay, right now it's 2.8. So that's what at the end of the day, that was how much they were up. But yeah, Cisco is a great company. It's in basically a network company. They provide all the infrastructures, for example, and now they get into the cloud side of things. They're trying to basically do more of a subscription kind of models. So they've got they're working on a lot of the big companies, which they were not previously. Okay, so currently trading at $55 per share, PE of 20. The sector is about 31, EPS of 2.69. Market cap of $226 billion. At one point in late 1999s, people were saying this company is going to become $1 trillion business. And look at it right now, almost God knows how many years later, it's basically $226 billion company. Annual dividend, basically what that shows you is sometimes people speculate rubbish. Okay, so you have to be careful and look at the fundamentals. Annual dividend yield of 2.75. 5-year growth rate of 9%, dividend growth streak of 10 years, and payout ratio less than 50%, which is amazing. Dividend safety of 91%, and then you've got free cash flow of $14 billion that they can spend buying back shares. I think they've actually said they're going to increase their dividend and buy back shares in their latest earnings. I haven't looked at it thoroughly yet, so I will be doing that soon. And don't be surprised if you see this stock actually in my portfolio very soon, because they are very stable and I like the dividends and I like the growth in the business. But yeah, and then you got beta, which is less than 1, which is good. Current ratio above 1, profit margin of 22%, return on equity 28%, and then future growth about over 5%. Over 5% for a dinosaur company that has been around for hundreds of years. I like that. okay, and they're still giving you dividends and they grow a little bit, and the price don't expect the price appreciation that much, okay, but it's all about the dividends is actually for this type of business, and the safety as well. So according to Simply Wall Street, is 34% undervalued. The target price is $82 per share, and it's a strong buy according to that website, and it's, according to me, is definitely strong buy. So I would be looking at this company in the next couple of weeks, inshallah. Fair valued when it comes to Morningstar, they're saying 54, is right now 55, so it's around the same. And then Tip Ranks is saying basically it should be about $65 per share. Right now it's done about 22, basically it's got 22% an upside according to this company. Right, so great company, like I said, is very safe, even though it's in technology sector. They have a lower beta, they pay such a good dividends, they've got a lot of cash, they're growing their business, and because everyone is now trying to build the cloud side of things, they're in a very good position. And if they can diversify their portfolios and start doing subscription based model, okay, where they can get like customers to stay with them and they have that stickability, okay, then I think this will be absolutely brilliant, just to keep in your portfolio to balance out, because some of the high flyer technologies, they've got higher beta and that can swing 5-7% every single day. Like for example, if you just quickly show you here, just yesterday Qualcomm was about 3% down, 3%. Look at Broadcom, it's the same thing. Look at AMD. So this is the type of business that you want to own in order to stabilize your portfolio. So the next company is Visa. It doesn't need any introduction. Currently trading $224 per share. PE 44, quite expensive right now. EPS $5, and market cap almost $500 billion. Annual dividend of 0.66. 5-year growth rate of 15%, 14 years of paying that dividend or increasing that dividend, payout ratio less than 22, and they actually increased their the 5-year rate is this, but I think it was only last year they even increased it just to 1 year about 15%, which is absolutely amazing. So going forward, I think this is going to go up. So dividend safety of 99%, free cash flow of $15 billion in the bank, just above 1, beta is above 1, current ratio above 1 as well, which is good. Profit margin 51%, and return on equity is 35%, or almost 36%. Future growth about 12%. According to Simply Wall Street, it is undervalued at the moment. The price they're expecting is 255, and it's a strong buy. Morningstar is saying fair valued and $221 per share. Tip Ranks is saying basically 275. So not much of a difference in terms of prices, but all of them kind of more or less agree it is either fair valued or basically as a buy right now. So great company, great business model. It's not going to go anywhere. People are talking about, oh, because of crypto, this is going to go away, this and that. Trust me, look, check your pocket. I'm sure you've got a Visa card in there somewhere. Okay, and that's the reason I think this business will be around for hundreds of years to come. I'll be honest with you, if it goes down below 210, I think I'll buy more. I think I've got about 10 shares right now. I would definitely look at it again. In something I'm going to share with you guys in a second after I finish this section, what is happening to my portfolio generally. I'll just quickly go over that, and I'll show you what the plans for some of these companies. Okay, so the next company we're looking at, Salesforce, is a company that I own. I've talked about it so much in the last few weeks, months, and so on. It's currently trading just $200 per share. The PE is super high in comparison to the sector because of the growth and all that stuff. EPS 1.8 to 1, $205 billion market cap. No dividends, obviously. They have a free cash flow about $5.5 billion. Beta is quite higher than obviously the market. Current ratio above 1. Profit margin of 7. Remember, these companies are reinvesting all their money, so this is not going to be I think in the next 5 to 10 years you will see maybe this hitting about 30-40%. okay, but right now it's not there. Future growth, that's the reason why this is not up yet, because they're probably taking all that money and putting it back into the business. So 30%. Currently undervalued according to Simply Wall Street, almost 40%. Target price of $352 per share. Strong buy. 320 according to Morningstar, 33% discounted, 58% is basically upside at the moment according to tip ranks. 330, so 330, 320, 352, so they've all agreed it's definitely undervalued. I've been buying more. Go and check out my Instagram account. I've actually bought, I can't remember, 1 point something shares of this business just this week. Now the final company, a little bit basically crazy. I know some of you guys own it. I sold it after I basically bought a very long time ago. I think early 2020. It was one of the first companies I bought. Since then, things have changed. They start growing their TV side of things, the music side of so the service sector or the segment of their business has grown so much, and for that reason I kind of felt uncomfortable with the Apple TVs and all that stuff and the music side of it. So I just felt uncomfortable, and according to Zoya is questionable. So I thought, you know what, there are other businesses out there, and alhamdulillah I took that money out, put it into Microsoft and other businesses that I like. But I know some of you guys own it, and according to Islamically it is actually Sharia compliant according to them. I don't know how, but I've got a video plan coming up soon, so I'm looking at their business model again and see if we can find why Islamically is saying basically it's fine. So inshallah we'll share that with you as soon as I finish. And then if you look at basically the business model, current price of $168 per share, PE 28, less than the market, EPS $6, market cap of 2.7, almost a $3 trillion business, annual dividend just above 0.52, and then 5-year growth rate of 9%, dividend growth streak of 9 years, payout ratio 14, so they can grow as much as they want. Okay, because look at the cash flow here, look at the free cash flow here, $101 billion, almost $102 billion, dividend safety 99%. And then you've got beta just above 1, current ratio above 1, profit margin 26%, return on equity 147, and then future growth about almost a 6%, 6.5%. Is undervalued according to Simply Wall Street. The price target for them is 191. It's a buy according to them. Morningstar says the same thing, 33% premium at the well, it says it's expensive. The price should be 130 and not 190, whatever. And then Tip Rank says it's actually 193. So they these two kind of agree, but Morningstar, I will definitely go with Morningstar. If you are one of the brothers or sisters that own this stock, maybe I would just wait until maybe it drops up out to 130s, 140ish. Just to give yourself a margin of safety if that's what you own. Right, so the final thing I want to talk about here, that's just the 5, and that we've done now with all the companies in here. Okay, all the companies in here, we've done it already that are Sharia compliant. So the ones that are not Sharia compliant, and we're going to leave them. Apple, I had a question mark, but I included since some of you own it. But yeah, so these are great companies that can literally sustain whether there's inflation, whether there is a stock market crash, whatever it is. And this is the kind of company that you wouldn't mind buying more of when the crash happens. Okay, unlike the high speculative that you will be worried about, like Home Depot. If it goes down 30%, you will definitely be loading up on that company. I would be anyway. Okay, so that's the kind of company I actually enjoy having in my portfolio. Now, just looking at this, right, I tried to allocate money into basically buy more of the stocks that I own. But when I look at it, I'm like, okay, a lot of them are right now, well, 4 stars, 2 of them are 5 stars, and then you've got fair valued on almost another 6, 7, 8 companies in there. So it's been really challenging to just kind of pick one of the stocks to add to and so on. But just yesterday, look at the change, right? So just in dollars, look at how much I've lost yesterday. 90. That's not even basically this whole portfolio, by the way. The shares are not accurate and the market cap value is not accurate because I couldn't be bothered to update it every time I make change. But yeah, so yesterday everything was down. Literally everything was down apart from West Management and Procter & Gamble. And these are the type of businesses, okay, that are almost a consumer defensive kind of companies. So yeah, it's tough. You're not alone if you think you're losing money. We're all on the same boat right now. At one point, this portfolio was up about 12%, whatever it was. Right now, it's only 5% up. Alhamdulillah, still up, right? I've taken some profit off the table long time ago. I haven't done any recently, so I'm gonna keep it as it is, see how it goes. I'm gonna add to it every single week. The £500, the 250, I'm adding that now. To be honest with you, I've been adding more than 250 lately, and inshallah I'm going to share a video coming soon just to kind of go over the portfolio, because I made one sell and took that money and put it into another company. So I'll share that with you guys, inshallah. I actually trimmed, I didn't sell the whole stock, so I'll share that with you guys. But yeah, I hope you enjoyed the video. I hope you enjoyed the transparency. I'm just trying to be honest with you guys. It's not easy right now, but you've got to make sure that you stay in, basically just keep going and keep doing your, like, whatever your plan is, basically stick with it. Okay, my plan is to buy quality companies, keep it in my portfolio, add to it every time I get the opportunity. If I have the money in the bank, alhamdulillah, I will add to it. Khalas, that's the end of this story, inshallah. Assalamu alaikum, brothers and sisters. Take care. Bye bye.